Dear students, today we are going to discuss about cost of capital. Uh, Cost of capital is an important topic under strategic financial management. In this topic, we will be discussing about the meaning of cost of capital, the definition of cost of capital, the significance of cost of capital, and the calculations of cost of capital. Cost of capital, it is a topic which you might have heard about before, but what is cost of capital? Cost of capital is the minimum rate of return expected by the investor while investing their amount of money into any business activity. We know that there are different types of investors involved in business, like equity shareholders, debenture holders, then preference shareholders, redeemable preference shareholders, redeemable debenture holders, bond holders, etc. All these investors have different perspective about their return on investment that has to be identified by the company so that they can fix the cost of capital and thereby they can satisfy the investors. So we'll see what is the meaning of cost of capital in the next slide. Meaning of cost of capital. An investor provides long-term funds, equity shares, preference shares, retained earnings, debentures, etc. to a company, and quite naturally he expects a good return on investment. In order to satisfy the investor's expectation, the company should be able to earn enough revenue. In order to maximize the shareholders' wealth through increased price of shares, the company has to earn more than the cost of capital. The firm cost of capital can be determined by working out weighted average different cost of raising different source of capital. So this is the meaning of capital given in the PPT. So simply cost of capital means the minimum rate of return expected by the different investors like equity shareholders, preference shareholders, retained earnings, and debenture holders, etc. Definition of cost of capital. According to Ezra Solomon, cost of capital is the minimum required rate of earnings or cut-off rate of capital expenditure. Then, according to Mittal and Agarwal, the cost of capital is the minimum rate of return which a company is expected to earn from a proposed project so as to make no reduction in the earning per share to equity shareholders and its market price. This is an elaborate definition as compared to the previous one. According to Khan and Jain, the cost of capital means the minimum rate of return that a firm must earn on its investment for the market value of the firm to remain unchanged. I think this is the definition which is much more uh, appropriate definition than the previous two definitions. Cost of capital depends on various aspects or various factors. So these are the four factors which really affects cost of capital. First one is demand and supply of capital. So demand and supply of the capital have to be identified by the company before fixing the cost of capital, whether the environment is good for rising finance or not. That has to be identified. The second thing is expected rate of inflation. So we know that inflation is a common phenomenon which we can see in all economy. So inflation is nothing but the continuous rise in general price level. So the inflation will reduce the purchasing power of people residing in that country. So while fixing the cost of capital, this particular thing also have to be identified by the company. Then various risks involved. So we know that there are various risks which is there in all business, like business risk, financial risk. Then there are certain risks which are beyond the control of the company, etc. So those risks also have to be considered by the company while fixing the cost of capital. And the fourth point is debt equity ratio of the firm. So we know that the debt equity ratio is one of the prominent solvency ratio used by management for decision making. And the ideal debt equity ratio is 2:1. So if a company is having a 2:1 debt equity ratio, they can simply follow a method for raising the finance through the various sources like equity, debentures, preference shares, etc. But they have to keep the uh, ideal debt equity ratio as what they have before. So these are the four factors which depends on cost of capital. Then significance of cost of capital. So there are seven significant factors or significant aspects are there in cost of capital or the importance of cost of capital. The first point is maximization of value of firm. Second is capital budgeting decision. Third one is decision regarding leasing. Fourth, management of working capital. Fifth one, dividend decisions. Sixth one, determination of capital structure. And the seventh one, evaluation of financial performance. The first point is maximization of value of the firm. So we know that the maximization of value of the firm is one of the long-term objective of financial management. In the short run, they have to provide adequate dividend to the investors so that they will be satisfied in the short run. And in the long run, they are expecting capital appreciation and they are expecting a very good return from their investment. Both have to be fulfilled by the company while fixing the cost of capital. Next point is capital budgeting decisions. So capital budgeting decisions are long-term decisions usually taken by top-level management in order to buy fixed assets, in order to buy land and other things which are involving huge amount of investment. So those kind of decisions, while taking those kind of decisions, the cost of capital aspect also have to be fixed by the company. The third point is decision regarding leasing. In some point of time, it is better to take the asset on lease rather than buying it. So sometimes it will be convenient for the company. So while fixing this decision, whether they have to buy it or they have to take it as lease, the cost of capital ingredient also have to be checked by the company so that they can decide better. Fourth point is management of working capital. So management of working capital is also one of the important aspect of any business organization. So working capital is nothing but the short-term requirement of the organization to meet its day-to-day expenditure. So working capital amount is, if any company is lacking working capital, a fund that will affect their day-to-day activities, and ultimately it will affect their long-term activity also. So cost of capital also plays a vital role on the management of working capital. Fifth point is dividend decisions. So dividend decisions are the decisions which are taken by the company for distributing dividend. So how the dividend can be distributed, how much it has to be distributed, and what are the various ways in which it has to be distributed, and what strategy they have to be followed. All those decisions have to be taken on dividend decisions. And while taking a decision with regard to dividend distribution, the cost of capital aspect also have to be considered by the management. Sixth point is determination of capital structure. So the capital structure is the structural framework of debt equity mix of an organization, that is known as capital structure. While fixing the capital structure, the cost of capital aspect also have to be identified, and we know that the cost of equity will be different, the cost of debt will be different. In what composition is good for the organization have to be decided by the company. So that is what the sixth point. Then the last point is evaluation of financial performance. The financial performance of the organization is also important, like how much cost of capital they have fixed for the investors. Every organization have to get more return than the cost of capital or the cost of equity, cost of debt, etc., so that they can provide the adequate return to the investors so that they will be satisfied. And if they are not satisfied, they will not be investing their amount of money into the business again. So that has to be fixed by the company on the aspect of financial performance. Then assumptions of cost of capital. So there are various assumptions we have to be followed while calculating cost of capital. So these are the three important assumptions. First one is, it is not a cost as such, it is merely a hurdle rate. So while we are discussing about cost of capital, we are always saying that it's a cost, but it is not a cost. It is merely a hurdle rate. So hurdle rate in the sense like the company have to attain this rate at least so that they can provide the minimum return to the investors. Then the second point is it's a minimum rate of return. It is not a maximum rate of return. It's a minimum rate of return. Every company should attain this minimum rate of return from that particular segment of activity. The third assumption is like it consists of three important risks such as zero risk level, business risk, and financial risk. So these are the three important elements of risk are there in cost of capital. So these are the various assumptions on cost of capital. These assumptions will help us to calculate cost of capital uh, so that we can identify how much is the cost involved on equity, how much cost involved on debt, how much cost involved on preference shares, etc.